Happy Friday, everybody. Hope you guys are doing well today. We've got the three amigos with me. Dan, Matt, Rusty. Boys, how you doing?
Morning.
Morning.
Good morning.
The lads are all here. Friday is the day we let Rusty eat some food, get out of the mine a little bit, and stretch his legs. And about 10:30, we'll send him back down and finish the day. So,
Nobody's gonna
anywho,
let me see the sun today.
yes. Speaking of sun, I got a beautiful sun for you here.
Every morning at 8:45 Eastern, option Omega's got your back. Troy's dreaming big like LeBron, mass backtesting like a daddy Mac. Dan's 30 years got our way, trading life and markets every day. Option Omega, you're traded home, where every move makes you feel less alone.
One of my favorite things to do in the truck now with the kids is just randomly just go, ooh, 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 ooh. They love that.
Sure, they're excited.
I like
They
that.
love that. Yeah, they love that. So, guys, it's Friday. It's a big day in the market. Big day for people who recently got vasectomies. You can see recent shows to make that connection.
That's right.
But yesterday's first day of the tournament. Any thoughts on the tournament, Dan? I know the tournament is your it's amateur basketball, and I mean that in the best way possible.
Yes, it's very limited. We don't have a TV at this season of life, so we do some reading. But my son was able to somehow he got on an ESPN, and we were able to watch some games. So I'm going to go with we watched a little, so I was excited. You could say a upset McNeese State beating Clemson. We lived in South Carolina, so like Clemson. But when you watch the game, you're like, whoa, this isn't, this don't look like a big upset. That was a tough team, McNeese State. And I know there's a storyline with that because the coach is he's leaving. And he told his kids, hey, I'm leaving. But so whatever motivation you got going in there, he might take three of them with him. But yeah, McNeese State would be, I guess you'd call it an upset from the rankings, but if you watch the game, it didn't look like an upset.
This is why I'd feel I'd be a terrible coach because I get so vested. I'm so competitive. And this is what I do every year if I was a coach at college. I'd go into there before the tournament, day before the tournament, and I'd say, guys, I'm dying.
I'm dying. Okay.
This is my last rodeo. And I would love to see us play our hearts out. And every year, I'd recover, win, lose, or draw. But I'd probably say something that would upset a lot of parents and things like. I'd also
you got to do it right.
I'd also hit kids like Bobby Knight, but that's a separate. So on the left here, there's a picture. That's not Oxford. That's not Cambridge. Do you know what school that is? Anybody?
No.
McNeese State.
I wish it was. I wish it was. That is Kraton.
Okay.
Now,
Where is Kraton?
I want to say New England.
Never even heard of it. Okay.
So
just kidding. I've heard of Kraton.
Kraton. This is how little I watch college basketball. Yesterday, when I'm putting this together, I thought, okay, well, Kraton is Kraton is always the upset school. They were only like 1 point. It was like a 9 and 8 seed playing. So it wasn't like that big an upset. But to me, I thought I see Kraton and I always imagine upset just because you only hear about them in the tournament.
Yeah.
On the right here, the last time St. John's won a game, Rick Pitino was the coach of the Celtics in 2000 and 25 years ago. He won St. John's first tourney game last night. St. John, Rick Pitino just wins championships. That's
Nothing
what he
like rooting
does.
for a cheater. Yep.
This I'm telling you, that guy definitely tells his kids he's died.
Oh my!
That's,
At
you
a
know,
minimum, right?
at a minimum. Yeah. For
Also,
sure.
I feel bad for the Cratonites among us. Creighton is actually not East Coast at all. It's Omaha, Nebraska. Quite not East Coast.
Well, I'll tell you why.
Just looked it
New
up.
England. What's Nebraska's state abbreviation?
NE, isn't it?
Yeah.
See, this is how stupid I am. I saw that this morning. I was like, "Oh, Omaha, New England." That's cool. I moved on.
Troy, where did you learn your states?
I was
Anyway, that's a whole.
I was
Okay.
homeschooled. All right, here we go. We've got OPEX upset today. Is today going to be the day where we've got triple witching madness? Dan, I love hearing these stories. Tell me what it was like on the pits when there wasn't daily expirations. There wasn't 3-day-a-week expirations. You just had options expiration.
Yeah, options expiration it was just such a weird, it had nothing to do, in my opinion, too much on trading. It had to do with all the guys in the pit had huge open interest in most of the strikes, but particularly it seemed like if the stock was at 100, there was massive open interest at 100. Well, the problem is you didn't want to be, if you were short all these options, 1,000 options at the money, what if somebody exercised them? They could, even though they weren't a quarter in the money. So you had this, it was kind of like an options pit dance. You had this, guys were doing this, doing these like spreads to get out of, they didn't want any shorts on. They want to be able to go home and not worry about, am I going to get assigned? So you had this dance of, I'll buy spreads from you, you buy spreads from me. Nothing was really being accomplished. But the only thing from a trading perspective was, people would say, well, it's a magnet. We can't move. We're at 100. There's 500,000 contracts of open interest. But what I've learned is when the market decides to move, right, it'll move. I don't care how much open interest is there. The market's bigger than 30 market makers or 40 market makers. And so, but it was a interesting time. And, but boy, I wish we would have had weeklies. I mean, what a different game now that you have expiration every day. It's like, if you want to, I mean, it's such a better time, an exciting time. Whoever invented the dailies and all that, my hats go off to whoever he or she is who did it, because it's just turned this game into a lot more interesting game, right?
What when you were let's say it's next Monday or this coming Monday.
Yeah.
So it's the first week after expiration.
Yeah.
Are all the options you guys trading on the pit, are the majority of those the next month, or would you go out? Was there a lot of flow coming in of like a year out, 2 years out with those?
No, there was. I mean, first of all, the week after expiration, a lot of guys would take off. A lot of people would, we had a guy from San Francisco. He just flew in for expiration week.
That's wild.
That's it. He flew in because he said it's useless. The other 3 weeks, I don't want to trade 20-day stuff or 20, but he'd come in on the Monday of expiration. He'd sell options for 6 hours. He'd sell options for 6 hours on Tuesday. He'd sell options in different, spreads, double count, whatever it is. And then he'd go back. And that made sense because the Monday after expiration, all they would do, a lot of it was selling pressure on your whatever next option out, 30 days out or whatever. But there wasn't a whole lot. Nothing was going on. So a lot of people would take time off after expiration. But expiration, even like Sosnoff and those guys, that was their week. They would just, because it's the joy of selling. These things are finally going to expire in 4 days. Sell them, and that created a lot of excitement because then, you get too many sellers. Some buyers are like, well, wait a second. I'm going to buy this option for $0.25, and we're only X amount of points from the strike. So the expiration week really brought a lot of enthusiasm to the CBOE and kind of a hangover the week after.
So
Interesting.
you're saying people would come in there just for the action that week? Like, why
Oh
waste
yeah.
time?
Well,
Let's just get the yeah.
yeah, and they saw with the time decay, they let, and
Mhm.
then it became like, why would I want to be here the next week? I've been selling, instant gratification. I'm selling options that'll expire in 4 hours or a day and a half. Now you're telling me after that thrill, go sell 30-day options. And they're like, no way, I'll come back. Or some guys, they'd come back when the options would get to, 7 days, 14 days even. And I don't blame them. Why? You make they made enough in that week to justify, staying in San Francisco for the other 3 weeks.
Yeah. It's interesting you say that. I don't know about you, the rest of you guys, but I hear that a lot from people in our community that are doing the 0-day stuff, right? I hear a lot of people say, I'm addicted to the 0-day. I can't do anything but 0-day because of what did you say? It's like the dopamine hit, right? Of like, oh,
Yeah.
why would I want to do overnight? Why would I want to wait a week for my money when I can get my money, end of day? It's so you kind of see that same mentality now shifted to the 0-day.
You do, but I think like you guys do with the double calendars, the 2 to 3 day stuff should be included, because that is, if you put them on 3-4 times a week, it's pretty close to it, right? It's not the exact dopamine as a 0-day. You're in and out, and you don't have the overnight risk. But when you can set up a double calendar 2 days out at a 15 or 20 delta and get a huge amount of room, that takes care of the gap risk in most situations, I would think. Not in August 5th, but it's pretty good, right? I mean, that it's worth trading something other than the 0-day.
It's interesting to me about that, like the dopamine thing, because as someone who has an addictive personality, I get that a lot.
Yeah.
And I'll bet anybody $1,500 that I do more than they do.
I've made
But
some
anyway,
prop
that's
bets
a
with Ryan
separate.
back in the day. Back at our work together, we made a lot of prop bets.
A lot
A
of prop
lot of
bets.
crap bets.
A lot of prop bets, including. Well, listen, this is a 30-second tangent. Yeah, a lot of COVID prop bets when it was in China. But anyway, that's a separate. So, one of the things that's interesting to me about that is, I personally, I mean, there's so much. As someone who loves dopamine, huge fan. Shout out dopamine. One of the funny things is people who love 0-day spreads. It cracks me up because that thing you said is true. They're like, oh, I like getting in, getting out, being done that day, getting my fill every day. If you want time to slow down, like if you want to feel every second of your heart beating, do like a 0-day spread. Like the people who have that, I'm like, that you're infinitely more patient, because if you want a 0-day dopamine hit, just do futures. Futures are like
That's true.
the
Yeah.
ultimate of it,
Yeah.
And so to me, now what's funny about that also, last thing I'll say before we move into the test, I have a bunch. So I'm automating 99% of my trading at this point, and I have balanced butterflies that get put on every day. I've got this strategy that I only put on up to 4 at a time, but or any 4 trades at any given time. But what's funny about that 30-day, they're always they're so calm, like they can take so much action. The only annoying thing about those farther day outs to me aren't that it's not doing what it should do or not getting out sooner. It's because the liquidity is so weird on those butterflies. Sometimes the bid ask,
Yeah.
you'll look at your account and you're like, oh, I'm up 50,000. Oh, I'm down 40,000. Oh, I'm up 50,000. Oh, I'm down 30,000. Like all day long, it just kind of blips your account.
Well,
And
that's a great point that unhinges a lot of new retail traders, because you tell people there is no such thing as a mid price. There's a mid range, and you kind of work around that. But when they see, okay, I just paid $8 for a balanced butterfly, and I'm watching the bid ask, and I say, first of all, why are you watching it? Go do something. Go do the wash or something. Don't, if you're in the graph and you're in the middle of the graph, I don't care if it says you're down $42,000, right? It's you'll get a bad price. But it is unnerving that if you pay $8 and you can see an hour later, if you watch it for a minute, it'll trade at 7, it'll trade at 9, and you're like, what's going on? And I'm like, nothing's going on. That's dealing with 30-day, it's a little different world as you get further out, and especially as the prices get bigger. The bigger the premium, the wider the market you can make it in the pit, right? Market makers have, they have rules. You can't, if you really wanted to be dastardly, hey, it's a $9 option, I'm going to be 2 bid at 15. Well, the CBOE has integrity. They're no. If it's a $9 option, they give you rules of how wide you can make that. If it's a 50-cent option, you can't make it 10-cent bid at $1, right? They'll give you, and so the wider, especially with in the money options, when you have a butterfly where one of the legs is in the money, that's what's going to do it. If that bothers you, you're doing butterflies, calls, or puts, do iron butterflies. Iron butterflies will have less deviation of the price because, I don't know if that's the right word, but it'll less movement because you're selling at the monies, right? So those are going to be tight, and you're buying an out of the money call, out of the money put. So you won't get it crazy as much. But if you're doing a call butterfly or put butterfly, one of the options is in the money, and that's going to throw that price scheme into a tizzy. So if that bothers you, do an iron butterfly in some capacity, because you normally you'll get less. It won't be jumping around.
Yeah,
or whatever that's worth.
That's great advice. Great advice, Dan. All right, so let's look at some tests real quick. And we're going to continue on a little journey that we started earlier this week, all the way back when I was in Myrtle Beach. Like all journeys begin at Myrtle Beach. This is can you guys see my screen?
Sure can.
Okay.
Got
this is a double calendar. And we did this a couple days ago. And we've slowly been improving it. And what this is on any point of the day, when you open, when you're up, the market's up, then, and two things real quick. This is Qs. So this is in the Qs, QQQ, NASDAQ. Anytime the market's up a minimum of 0.1%, so 0.6, you allocate one contract and you buy one double calendar. And this is a 9/23 double calendar. And you might think that's a crazy spread, especially if you've done DCs and you're used to like 1 2-day spreads or 1 7-day or 2 7. This is a big spread. And what this gives you, what we talked about in the previous days, is a 9/23. You're going to start out positive theta. So even if we don't do anything, you're going to collect some theta the first couple of days. So you've got that on your side. And what we talked about was the guardrails, putting guardrails on your tests. This is the guardrail for this is you're going to exit when the call gets tested by 1 point. So it goes 1 point in the money of the short to the put or the call. So if you go past the call by short call by 1 point, you get out. Go past the put by 1 point, get out. We've got some opening fees and things like that. Those are always going to be a little bit different, on any given basis. But this is the test right now. And as you can see, it really does pretty well. And what we talked about was one of the reasons I think the premise is this does well is you're putting it on when there's a vol reduction, right? And with 9/23, you're getting a lot of Vega. Like you're buying a lot of Vega with those long dated spreads compared to if you bought them with the shorter spread. And so because of that, you're putting it on and you're setting your odds in your favor a little bit because you've had a vol reduction. You're not going to get killed on the vol move, at least this one. It could continue to go up. It could do all sorts of things, but you're kind of setting yourself up. Before we and what I want to look at today is taking this test and doing different allocations. This has just been with one contract, so we're going to look at some different allocations. But lads, what do you guys think of this? And do you have any thoughts about how this is going to go as we look at it?
Well, I'll just say that I think this is a super important topic to talk about. And here's why. When you look at a backtest results screen like this on Option Omega, your eyes are immediately, a lot of people are drawn to the starting capital and the ending capital, or they might be drawn to the CAGR or the MAR. And all of those are important, but you can really only understand them in the context of what you're doing. Here's an example. If I said I had $1 million, that's great. $1 million in Zimbabwe of Zimbabwe dollars means something different than $1 million Canadian dollars or Australian dollars. So understanding the context of what you're looking at is really important. And so as we look through this, the allocation size, understanding the context of this is how much allocation, this is how much risk is on in these trades in the backtest, will really allow us to better compare risk reward. It'll allow us to feel the drawdowns and see the potential drawdowns more. So I think this kind of stuff is really important. We try to talk about that a lot in Option Omega. You can't accurately compare the MAR of a backtest that's 30 days at 100% portfolio allocation versus a MAR that's at 3% portfolio allocation and has an 8-year backtest. Those are two different things. So context matters. So this is great. I'm excited to get into it.
And you're saying that specifically because it's capped at one contract, right? So you're just
the context of this is what I'm saying is you have to, step one, understand the context of what you're doing. So the context of this backtest, what's the context? It's going on every day, but it's only putting on one. So there will be sequence risk, but if you're just putting on one a day, there's going to be a lot less sequence risk than if you're uncapped. And conversely, there's going to be a lot less reward if you're uncapped as well. So uncapping it and changing the allocation will be really beneficial, I think, to get more information.
I think you could be more blunt and say, I mean, when you cap something at one, what's useful is probably that bottom row and maybe even the capture rate because it's held constant.
Yeah.
But what's useless, like CAGR is compound annual growth rate. Well, you don't have compounding anything when you're capped at one. So you just have to know that, right? Like the top row is useless essentially with any kind of capping, whether it's one contract or 10, because you're not compounding. You're just not compounding. And so that whole row is useless, but the bottom row is useful. And so you just got to know those things. That's all.
Last thing I'll say, and Dan, if you have anything, feel free to before we jump in. But you mentioned, Matt, that Canadian dollars and Zimbabwe dollars aren't the same. After we're done with them, they might be. Holler America! Shout out America! Anyway, Dan, do you have any?
I mean, the only thing in general when I think of a 9 versus 23, you know, as you take that long contracts and go further away from the short contracts, your volatility risk is going to go up. Your Vega is a little more sensitive. So I like the fact on this test that you have a minimum move up. So you're already getting a head start on volatility going down. But generally, if I'm doing a 9, you know, what would make me do a 923 versus a 912 or a 915 or something? And usually it's going to be the VIX in some capacity that, hey, I don't like the levels. You know, if VIX is 12 or 13, I know we're talking Qs, I'm not as familiar, but if the VIX is lower, I'm all in because I'm thinking I have very little volatility risk. If we're at 12, I'll do whatever, you know, you do bigger size because we don't often go lower than 12 in the VIX. But if we're, so that would be my biggest concern. Usually in double calendars, it's more the volatility because again, you're going out, you know, 20 deltas for a short term, you know, I'm not saying you can't lose on price. And Matt has talked about some that you can, but overall, what I've seen, and at least in our community, is volatility could be just as nasty especially with, what do you call them, Matt? Not double calendars where you do the inside.
Like an double inside diagonal.
Okay, yeah, something like, okay, those can be. But anyways, that's what I'm thinking. So I just like the fact that and I also think it's a really good point Rusty brought up about, and Matt, with just the whole allocation thing. If you're just doing one, right, versus a compounding, I don't think a lot of people look at that, right? They just, but I, one last thing and for especially beginner traders, I don't want them compounding a lot of time. I'd rather do, prove you can do, not prove, but do 10 double calendars or 10 single calendars in a row, get your feet wet before you increase your size for a beginner. Because you don't want a beginner, okay, they can get lucky, the market won't move. And now they started with one, they're doing 4 contracts after they've only been trading for 3 weeks. And I don't know, it just gets a little dangerous. I say build the foundation, but that's more with beginners.
That's a great point. And that's why we did this last for this type of trade and this is what I would encourage you to do. I mean, we all test in different ways, but the way I test is I want to see with one contract if it's even going to work.
That's
right? If something even works. And then I will test different allocations. And this is kind of my point with it is allocation is part of the strategy. Too often we see strategies as good strategies and it doesn't matter what allocation. Like we've all encountered this where it's like, it's a great strategy. So the more money, the merrier that I put towards it. No. Because allocation is part of the strategy. And I'll show you. Let's go ahead and jump in. So this is one contract, right? This is, again, we're going to just measure this by MAR. And it's 2.2. So let me do this. Can you see this now? This is a 2% allocation. Okay. So this is a 2% allocation on $100,000. So you're putting, starting out with 2,000 worth of this. Now let's jump into this a little bit because one of the things you'll notice, the prices, they're going to change through time.
Yes.
But your prices with this is you're probably going to be able to get 2 or 3 put on at the beginning, right? If that makes sense. And so this is still pretty small, and you'll notice that we have gone up and allocation was still a pretty good low drawdown of 2.8%. Is that surprising to you guys? Thoughts on that before we dig into more?
It makes sense to me. I mean, if you look at the your CAGR went up quite a bit, right? But your drawdown is also going to go up commensurate. It makes sense, right? Because you're increasing your size. So kind of
pretty straightforward, right? Okay, so let's keep going. This is a 5% allocation. So again, MAR goes up, your drawdown's going up, to Rusty's point. Notice though, between the two, your P&L has actually gone down. So your MAR's good, but your P&L's gone down, your drawdown's gone up. Rusty, what's the deal with that? How is that possible?
Can you go back to the previous test just so we can compare them? Can you tab back and forth? I'm just curious. So we got 21 point. Oh, sorry. I hate to put you on the spot.
No, let's do this.
Just what happens when you get the coal miners on here.
That's right. 2% allocation right here.
So your starting capital's different. I think maybe that messed with your P&L.
Oh, shoot. I'm going to do this.
Sorry. You put me on the spot.
No, that's perfect. That's perfect. That's perfect. So we're gonna run that real quick and do that.
Yeah.
I'm glad you caught that.
Yeah, so this kind of goes back, right? Since we're looking at allocation, and if you're going to dig into these stats, like my favorite one is the CAGR, or the MAR and the CAGR both, because MAR kind of gives you a risk management approach, but also wanting to do compounding. And I'll just say, yeah, all these things are impacted by starting capital, allocations, like all that kind of stuff. That's all.
Yeah, for sure. Okay, so back to 100,000.
There you go.
There we go. So that makes sense. He solved the problem. So your MAR has gone up to 3, but your drawdown has gone up as well. But obviously, you're making more money, so that makes sense. So again, we're on the same track right now, right? Does it make
and it's not gone up with the same ratio, right? So your CAGR has gone up faster than your drawdown, which is a good thing. That's
That's
what you
right.
want.
That's right.
Yeah.
Okay, so this is a 5% allocation. Let's go to a 10% allocation. So again, MAR is going up, CAGR is going up, drawdown has gone up. Everything's going up, including your P&L, right? Now, again, this is Dan as a risk manager, one type of trade. Still a relatively small part of account, 10%, that's probably about what you'd want to in real life get comfortable. How do you feel about this right here? The 15% drawdown over time.
I like it if the thesis is trader A started with your earlier tests, right? If he started with your earlier tests of one contract, built the foundation, understood it, accepted it, believed in the trade, then I think when he comes here, as Jack Nicholson in the movie, Can You Handle the Truth? I think he can handle a 10% allocation because he's built the foundation. By this point, he might have 50 Q doubles under his belt, right? And I think not that you ever want that type of a drawdown, but I think it's not going to discourage him that he would stop trading. At least that's my, I don't know if that's,
yeah, no, I mean, I think that's right. And the thing that's interesting about this one, this trade, is I always like to look at the trade log because it gives me a sense of like what it would look like. And so you look at this run right here, and you say, okay, this is a great winning streak. Now, we talked about this the other day, but one thing to note: if you're a smaller account, you don't want to see that. You want to adjust this test to get out before, right? Because Qs are assignable. So we're letting it ride to 4 p.m. and letting the brokers take it from there. You don't want to do that.
Yeah, and the back test is closing it at 359. But to your point, you could easily add a close earlier in the day after the MOC or after the NASDAQ MOC or before power hour or whatever on the 0 day.
Yeah, that's right. And so what I want to do real quick is do a little bit of live back testing. We don't like to do this, but I'm going to show you something year to date. I want to run this same test year to date and see how we've done. Okay, you've done pretty well. And just for time's sake, I want to keep going. And I'm going to allocate just year to date. We're going to go up a little bit. And I want to see before we go up, what do you think is going to happen the more we go up, guys?
The
I gave it away already.
Drawdown and CAGR are both going to increase.
Yeah. So let's move it up. Let's do a 50% allocation because we're stupid. We're going to do 50% allocation on our Qs
because we're stupid.
Double calendar.
Yeah.
This is there it is. That's what I was waiting for. So you might this is one of the most important things to me about backtesting is testing allocation. Because I have personally in my life over allocated winning trades, right? And one of the things that is the art of this is managing your risk by seeing allocation as part of the strategy.
That's it's a great point, Troy. This is dead on.
Because you were on the Delta 8 or whatever the kids are saying now. You were on the DMT or whatever the podcasters are telling you, because you allocated 50% to a winning strategy, you now have lost a lot of money, right? Allocation, it's the name of the game. You have to account for it. And so you can't just trade one contract. You start with that, maybe. You figure out what is working. And then you quickly need to test allocations, because in real life, if you have a winning trade, you're going to say to yourself, I need to put more money towards this trade. And some tests, that's true. Very rare ones. That's the way I look at it. Guys, any parting thoughts as the market deteriorates, as it's custom when we're on?
Well,
Oh,
the most interesting thing about that test is I actually think that was you talked about risk management, right? And you're exiting only 1 point on the underlying past your two, what we call, tent poles, if you will. That's a pretty safe way to manage that. We're not letting it get 50 points in the money or something crazy. And so now I would say it'd be even safer if you exited 3 or 4 days before expiry on the shorts, would be even safer. But the point is, it's not a YOLO test, right? It had guardrails, and so you might think to yourself, this is a safe test. It'll never lose. That's your point, right? Even with good risk management practices into the trade, in the mechanics of the trade itself, to your point, allocation size is another portion of risk management that you have to add in. You can't just go all in on one strategy with 100%. I mean, you can until you go bust, right? You
Yes.
could do it. You can play that. Maybe you get lucky and you get out and you get your yacht before you go bust, but that's called survivor's bias. So you muted, Troy, I think.
Dan, tell me one more time. You've said it before. The story of the guy who called you with the inordinate amount of iron condors.
the Texas story.
Oh, the Texas story was our first mentoring session. He had an iron condor on his screen, and it was like, I don't know, like 5, 6, whatever 100 iron condors. And I said, I'm just curious, because he was showing me an example. I said, oh, that's a nice example. He goes, no. This is a live trade. I wanted to get a feel of this strategy. I've never traded it before. And I said, why would you do it that big? Could you please make me comfortable and get rid of 95% of it? I go, why did you do that? And he goes, because I can. And if you can believe it, it was kind of a humble. It just, hey, maybe I've got 7 oil wells or whatever. I can do things like that. But wrapping it up real quick with what you said with the allocation, I think my concern is when people will look at like, okay, maybe people do it. I'm just throwing a bad example here. 0-day iron condors. VIX has been 25. Well, you don't understand. I can do these iron condors, and there's 230 points between the shorts. These are stellar and understand it. And I'm going to increase my allocation, and that people understand thoroughly what it. My thing is education, that they understand what it is they're doing. You can make money in a 12 VIX or 13 or 14 VIX environment with an iron condor. I mean, I think there's other strategies you could do that might be a little bit better, but I think people look at that, and I've had people call me up and say, Dan, there's no life. Now that we're back to 15 volatility, I used to do iron condors. They gave money away, and I'm like, whoa. You ever think about why, when VIX gets over 20, do you ever think about what market environment that is? That's a scary environment. The market's going down very fast, and you're talking like it's like playing on the west side of Chicago at 3 a.m. and calling it a pleasant experience. I mean, good grief. So I think there's a lot of, I want to call it, I say the Yahoo hat. Most people trade options. They've worked very hard in their life to build up some extra money, but sometimes when they get in this world, they put on their Yahoo hat. This is same as any other business. And when you're in a 20 VIX plus environment and saying this is wonderful for range bound trades without any soberness or seriousness, I just think that's a little difficult because it is a volatile environment, right? And you need to be careful. You need to ask some more questions. So, anyways,
last thing I'll say. Let me do this real quick, just while we're on this about sizing. Can you see my screen?
Yeah, we got you.
Great book. If you're interested about just how allocation is a strategy, this is one of my favorite books I've ever read. And it's about the Kelly criteria. And someone mentioned the chat, but it's basically the story of how the Kelly criteria came to be. And it started as a gambling formula.
Oh, really?
And any gamblers who have stayed in the business a long time allocate. That's all. It's all about allocation to them. Odds and allocations. So anyway, just wanted to say that. Guys, listen, market's having fun this morning. we should go to it, have some fun with it. But happy trading, everybody. Thanks for joining us this week.
Happy
It's fun.
triple wishing.
That's
Yeah.
right.
That's
Enjoy
right.
the
And
day and the weekend.
we'll see you Monday. We'll have things we'll want to talk about, and you will too. So bless.